Hey, a very warm welcome to the course. First of all, the mandatory and sensible disclaimer. Listen, spread betting is very risky. You're taking on risk, a lot of it. No advice or recommendation to trade is given in this course. It's just me sharing my knowledge. It's just for information only, for educational purposes only. I'm not advising you to take any specific trade or do anything specifically. There's no guarantees to any success. Some people are very, very successful spread betting. Some people aren't. The same with everything in life. Please only risk what you can afford to lose. If you do decide spread betting is for you, then please start on a demo, and then if you're going to trade with real money, trade a very, very small amount and grow your account in that manner. And also be aware that it's possible to lose more than your initial investment. Under certain circumstances, you can lose more than your deposit. So please understand exactly the risks you're taking when you're placing trades. And finally, just be aware of some brokers. But we'll go into that into more detail later on, and I'm going to guide you as best that I can. So let's start out with spread betting foundations. What actually is trading? How does it work? This is the fundamental basics of, if we understand how something works, then we can build from the ground up. And this is what this course is all about. The whole course is about adding layers of foundation, building slowly until you get to a point where you have enough knowledge to go out there and spread bet for yourself. So how do traders make money? Well, first of all, traders make money by capitalizing on market oscillations. And when I talk about a market, I mean something like the German DAX, something like the US Dow, something like crude oil, gold, silver, or a stock. Could be a stock like Apple, could be a UK share like Marks and Spencer's. Traders make money by buying and selling at a higher point, and that's called going long, or they sell and they buy back lower, going short. So whichever way the market's moving, they're attempting to capture those moves. Now, there are different types of trading. You've got scalping, which is very small, quick profits from the market. So you're in for maybe a few minutes, even a few seconds, and you're grabbing small little profits, and you're in and out very, very quickly. Very intensive way of trading, but can be very profitable. Then you've got standard day trading. So that's basically trading in and out of a market or several markets many times a day. So you might be watching the DAX and the Dow, you might be watching gold and silver, you might be watching a handful of shares, and you're trading in and out of that market during that day, going home flat at the end of the day and starting afresh on the next day, and just looking to capture those moves intraday. Swing trading is a little bit longer term, so you're taking a trade during the trading day and you're looking to hold that over perhaps a period of a few days, maybe a few weeks or maybe a few months, depending on how you're defining swing trading. And then obviously investing is buying for the long term, but we're not interested in that in this course. What I'm going to talk about in this course primarily is day trading. Scalping is a little bit finer, it's a little bit of a finer art. However, a lot of the strategies I talk about later in the course is very valid for scalping. You're just going to reduce it down to a smaller time frame. Similarly, with swing trading, you can just use the same strategy but on a longer time frame. But we'll go into all that detail throughout the rest of the course. But all you need to know now is that there are three types of strategy, generally speaking, and to how you can approach spread betting.